Welcome, everyone, to the FAFSA Made Simple webinar. Here at Polygence, we take all of your feedback and all of your questions very seriously. And one thing that I've heard from speaking to our partners is that people still have a lot of questions about the changing FAFSA and changing financial aid landscape. And so we are happy to bring on a financial aid expert, Mark Kantrowitz. Many of you already know Mark, and I will let him take it away. Welcome,
Thank you,
Mark.
Maureen. So this is a talk about FAFSA simplification, and I have a bit of experience with the FAFSA. I helped develop the online FAFSA in 1996. I wrote a best-selling book, Filing the FAFSA, which is now out of print, and a more recent book, How to Appeal for More College Financial Aid. After discussing the advantages and disadvantages of simplification, I will discuss who benefits and who doesn't from the changes. For example, students in single-parent households will get more financial aid, while middle and high-income families with multiple children in college will get less financial aid as compared with last year. There's a new financial aid formula for federal Pell Grant eligibility. The financial aid form and formula will change to better align the FAFSA with federal income tax returns. And there are also changes in the cost of attendance and financial aid appeals. So some questions have been eliminated while others will be answered by transferring data from the IRS. Transferring data from the IRS will now be mandatory with the IRS data retrieval tool. It previously was optional. And intelligent skip logic will reduce the number of questions that individual applicants must answer. The number of questions will be reduced from 108 to 46, in some cases less, and that cuts the length of the form by almost 2/3. The questions about selective service registration and drug conviction have been dropped from the form. The U.S. Department of Education published a roadmap for implementation of the new FAFSA, which states that the 2024-25 FAFSA will be released in December 2023. The exact date in December is not yet set. I wouldn't be surprised if it's the end of December. The delayed start is due to the complexity of simplifying the FAFSA and building not just a new form, but a new platform for the underlying the FAFSA. The Consolidated Appropriations Act of 2021, which included the FAFSA Simplification Act, devoted 167 pages to simplifying the FAFSA. Now, this year may be a December start date, but it will return to the October 1st start date, starting with the 2025-26 FAFSA. The changes that benefit single-parent households include increases in the Income Protection Allowance, or IPA, that shelters a portion of the student and parent income, and greater eligibility for the federal Pell Grant. Financial aid eligibility will decrease for middle and high-income families due to changes concerning the number of children in college, the small business exclusion, and the family farm exclusion. Traditionally, the federal student aid formulas were focused more on income than on assets. There have been a few changes, however, that shift the focus from cash flow to a slightly greater emphasis on wealth. In particular, the changes in the use of the number in college shifts the focus of need analysis away from cash flow. The new federal Pell Grant formula makes it easier to determine who will qualify for the maximum federal Pell Grant. It also expands eligibility by a bit. Now, paid preparers can no longer charge for completing the FAFSA, except that a federal income tax return prepared by a paid income tax preparer may be used to complete the FAFSA. Now, the redesign of the underlying FAFSA platform will allow the U.S. Department of Education to increase the number of colleges listed on the FAFSA from 10 to up to 20. Parents who have an individual taxpayer identification number instead of a Social Security number, and parents who have neither will be able to get an FSA ID. Pretty much everybody will be able to get an FSA ID. We'll see if there are some little glitches in the process, but the expectation is that they're going to be able to do this so that people can sign the FAFSA using their FSA ID. Now, FAFSAs are less likely to be selected for verification because of a reduction in the number of questions and because more data will be transferred directly from the IRS. This will help eliminate verification as a barrier to financial aid eligibility by reducing the number of times low-income students must prove that they are poor. And given that the income data is transferred from the IRS and income data was the most often selected for verification, I'd expect to see the number of FAFSA selected for verification to drop from about 1/3 to the single digits, saying 7, 8, 9%, somewhere in that range. The new names on the FAFSA are more descriptive, but they don't make college more affordable or the FAFSA easier to complete. The term EFC, or expected family contribution, was a bit misleading because many families incorrectly believed that the EFC was all they needed to pay. Most families pay more than the EFC. Most colleges leave students with unmet need. Even when a college meets full need, financial need is met with loans. Loans must be repaid, usually with interest. Colleges that replace loans with grants in the financial aid package often redefine financial need for that purpose. For example, a minimum student contribution sets a minimum EFC greater than 0, even for low-income students. And students will no longer be required to register for selective service to qualify for Title IV federal student aid. Students who are age 26 and older who did not register will no longer be required to demonstrate that their failure to register was not knowing and willful. But men aged 17 to 25 are still required to register with selective service, just not to qualify for federal student aid. Since the question has been removed from the FAFSA, men will no longer be able to register through the FAFSA and instead will need to do so at the sss.gov website or at a local U.S. post office. Now, some states require selective service registration for a student to be eligible for state grants. However, many of these states have started passing laws to change that. For example, California used to require it and now no longer does. So you need to check whether your state still requires it. It takes a while for the states to pass legislation to fix this. Okay. The suspension of student aid eligibility for students who have been convicted of the sale or possession of controlled substances while receiving federal student aid has been repealed, so that question is gone. Now, there are new questions. Well, one of them is an existing question about gender, race, and ethnicity. These questions are optional and do not affect financial aid eligibility, such as the types and amounts of financial aid they receive. And they are also not shared with the colleges because some students may be concerned about that. These questions were added to enable the analysis of aggregate demographic data and for research purposes. Now, the U.S. Department of Education has said that the 2024-25 FAFSA will be available in the 11 most common languages spoken in the U.S., but has not yet specified the languages. It is likely that these languages will include English, Spanish, Chinese, both Cantonese and Mandarin, Tagalog, which is Filipino, Vietnamese, Arabic, French, Korean, Russian, Haitian, Creole, German, and Portuguese. Other languages such as Hindi, Italian, Polish, Yiddish, and Japanese will be supported through the Federal Student Aid Information Center. I base this list on an analysis of the most common languages spoken in the U.S., but we don't yet have the official answer from the U.S. Department of Education. Now, there is going to be less financial aid for families that have multiple children in college. The question about the number of children in college at the same time will still be included on the FAFSA, but it will no longer have any impact on the student aid index. Now, about 40% of families have just one child in college at the same time of those who have multiple children. 20% had 1 year of overlap, 25% had 2 years of overlap, and 14% had 3 or 4 years of overlap. So this change has a significant impact on families. Now, the income protection allowance was previously reduced by the number of children in college, since some of their costs were shifted to the cost of attendance. For example, in the 23-24 FAFSA, the income protection allowance was reduced by about $3,600 per child in college. So dropping this reduction in the income protection allowance will increase financial aid eligibility by up to about $1,700 per child in college. But this is less than the decrease in aid eligibility due to the parent contribution no longer being divided by the number of children in college. The impact on low-income students is small, in part because many of these students are already qualified for the maximum federal Pell Grant, and the parent contribution was typically quite small. Some middle and high-income students who previously qualified for a federal Pell Grant will no longer qualify as a result of this change. For example, some parents with low six-figure incomes and multiple children in college at the same time might previously have qualified for a federal Pell Grant, but are unlikely to continue qualifying. When you went from one child in college to two children in college, it was almost like dividing the parent income in half. Or if you had three children in college, even more likely. But that will no longer be the case. The current FAFSA, the new FAFSA, focuses the current FAFSA focuses more on cash flow than on wealth, reasoning that parents who have two children in college at the same time do not have twice as much money available to pay for college. The new FAFSA changes this and will no longer provide families with any benefit from having children overlap in college. This decreases aid eligibility significantly, especially for middle and high income families who have multiple children in college at the same time. Some policymakers saw dividing the parent contribution by the number of children in college as a loophole that mainly benefited wealthy students based on the timing of their children. And Senator Lamar Alexander, who chaired the Senate Health, Education, Labor, and Pensions Committee, was adamant about getting rid of this. It's not something that public policy proponents like myself asked for. He did it on his own without any prompting from us. Now, there are going to be some significant increases in financial aid for single parents. Single parents include both dependent students living in a single parent household. The parents are divorced, separated, never married, or one parent died, and as well as independent students who are themselves single parents. More than a quarter of independent students are single parents. The income protection allowance shelters a portion of student and parent income. The income protection allowance will increase for all students and parents, but it will increase more for single parents. The income protection allowance increases by up to $2,400 for most students, but by $6,500 for students who are single parents. The poverty line thresholds for single parents are also higher in the federal Pell Grant, in the new Pell Grant formula, which we will now address. The new federal Pell Grant eligibility formula combines the current formula based on the Student Aid Index with a new formula based on adjusted gross income and a multiple of the poverty line when determining eligibility for the federal Pell Grant. This is similar to other means-tested federal benefits, such as Medicaid, which is 133% of the poverty line, SSI, which is 75% to 109% of the poverty line, SNAP, which was previously known as food stamps, is 130 to 200% of the poverty line. TANF, previously known as welfare, is 50% of the poverty line. WIC is 185%, and LAHEAP, which is heating assistance, was 150% of the poverty line. So it's a known metric that has been used previously by the federal government. Now, although income is based on the prior year, the poverty line might be the most recent federal poverty line, though I think they're going to use the same year for the federal poverty line, but they haven't yet announced those details. So eligibility will depend on the Student Aid Index, the student's dependency status, adjusted gross income, single parent status, family size, and the federal poverty line. Now, the federal Pell Grant amount is equal to the maximum federal Pell Grant minus the student aid index, provided that the student aid index is less than 90% of the maximum federal Pell Grant. This means that there's a minimum federal Pell Grant of 10% of the maximum. An applicant with 0 or negative student aid index is eligible for the maximum federal Pell Grant. That's the old formula, which still applies. However, a student is also eligible for the maximum federal Pell Grant if their adjusted gross income is less than 175% of the poverty line. That threshold is increased by 50 percentage points to 225% of the poverty line for single-parent households. And 225% of the poverty line is roughly the same for a single-parent household as a $15 an hour minimum wage. The cutoff for a minimum federal Pell Grant is 100 basis points higher than the threshold for a maximum federal Pell Grant, except for independent students with dependents other than a spouse, where it's 175 percentage points higher. So this is a little bit complicated under the hood, but in implementation, it'll be easier for families because they just have lookup tables. Now, if a student doesn't have an adjusted gross income because they are not required to file a federal income tax return, they will be eligible to receive the maximum federal Pell Grant. The addition of this new formula on top of the old formula expands eligibility for the federal Pell Grant significantly. More than 500,000 additional students are expected to qualify for the federal Pell Grant as a result. And of those who qualify, of all students who qualify for the Pell Grant, more than 1.5 million additional federal Pell Grant recipients will qualify for the maximum federal Pell Grant. So this is going to have a significant impact on Pell Grant eligibility among those who qualify, increasing the number who qualify, and among those who qualify. Now, there are some changes in income that is reported on the FAFSA. Several types of untaxed income will no longer be reported on the FAFSA. This reduces the number of questions on the FAFSA, and it was done because very few applicants actually answered these questions. And there was a threshold of less than 1% of applicants answer a question, it was considered for elimination. Now, in particular, the cash support question to the student will be eliminated. The elimination of the cash support question means that gifts to the student and qualified distributions from a grandparent-owned 529 plan or a 529 plan that's owned by anybody other than the student or parent will no longer affect aid eligibility in any way. It used to be that grandparent-owned 529 plans had a very serious negative impact on the FAFSA. Now it'll have no impact whatsoever, and so families may start wanting to switch from parent-owned 529 plans to grandparent-owned 529 plans. Now, the child support is going to be reported as an asset instead of as income. This was done to reduce the impact on eligibility for need-based financial aid. It was done for the side effect, not to reflect the nature of child support. Now, there have also been changes in reportable assets. The small business exclusion and the exclusion of family farms from assets have been dropped on the form. There is still an exclusion for the family's principal place of residence. So a family farm might still qualify as a family's principal place of residence if the family home is on the farm and the farm and the home are covered by a single deed. But otherwise, if it's a farm that's not part of the home, it's going to be reported as an asset. Now it's the net worth of the asset, so if it's encumbered with a huge mortgage, and the actual impact may be much lower. The auto zero C no longer has a specific income threshold. Instead, the student aid index will be 0 when adjusted gross income is less than 175% of the poverty line, or 225% for single parent households. There have been significant changes in the design of the simplified needs test, starting with its name. Applicants can qualify for the exemption from asset reporting, which is descriptive, although not as easy to remember, either through the type of tax return test or the receipt of means-tested federal benefits test. An income threshold is required for the type of tax return test, but not for the means-tested federal benefit test, because those means-tested federal benefits have their own internal thresholds. The income threshold for disregarding assets will be increased from $50,000 to $60,000. Now, the current FAFSA bases eligibility on whether Schedule 1 was required with lots of exceptions. Eligibility will now instead be based on whether the taxpayer filed Schedules A, B, C, D, E, F, or H, with Schedule C involving just a gain or loss greater than $10,000. The means-tested federal benefits include the Earned Income Tax Credit, SSI, SNAP, TANF, WIC, Medicaid, refundable credit for coverage under a qualified health plan, or QHP, the free and reduced price school lunch, and the federal housing assistance. Now, the free and reduced price school lunch is maybe a little bit quirky because some states, and during the pandemic, expanded it to everybody, and they're continuing to do that. But that will still qualify as a means-tested federal benefit. The simplified FAFSA, unfortunately, doesn't fix the disappearing asset protection allowance. It's now either zero or near zero. There's a draft of the form that suggests that it's returned from zero, though it's still very small. I think that's an error. Now, I rattled off the names of a whole bunch of schedules. Schedule A is itemized deduction. B is interest and dividends. C is business income or losses. D is capital gains or losses. E is income from rental properties, royalties, partnerships, S corporations, estates, and trusts. F is farm income and expenses, and H is household employment taxes. And the general theme of these is that oftentimes these are ways of manipulating income. And in order to use the simplified needs test, or applicants exempt from asset reporting, it had to be the unmanipulated income. And so if you had used one of these schedules, it would make you ineligible. Now, which parent must complete the FAFSA? When the family relationship has dissolved, only one parent is responsible for completing the FAFSA. Otherwise, both parents must complete the FAFSA. Now, if they file a joint tax return, it's easy. If they file separate returns, both of them must agree to have their tax information transferred from the IRS. If they don't agree, then the student doesn't get financial aid. So if you file married, filing separately, each of you is going to have to agree to have your information transferred. Now, if the parents are divorced or separated or never married or widowed, and this parent who completes the FAFSA, and we'll get into which parent in a second, if that parent has remarried, the step-parent's information must be reported on the FAFSA, regardless of any prenuptial agreements. Family size will now be based on federal income tax returns, which has a different definition of qualifying children and qualifying relatives. But there will be an ability that if you've had a child born or will be born since the prior year, you'll be able to increase the family size on the FAFSA. Now, children must live with the parent for more than half the year and must not provide more than half of their own financial support to be on the federal income tax return. However, a temporary absence for school does not affect whether a child is considered to be living with the family. But the requirement that the children live with the parent may affect whether a step-parent's children from a previous marriage can be counted in family size. Financial aid no longer counts as part of the student's own support. So this may affect whether graduate students count in family size, because many graduate students had significant student loans, which counted as part of their own support. Now they no longer count. Now, if a child is married, they must not file a joint tax return with their spouse. This is from the tax IRS. This is the old FAFSA didn't have anything relating to that. And children must be under age 19, unless they're a full-time student, in which case it's age 24, to be counted in household size. Now, some details have yet to be determined. The new law provides the U.S. Department of Education with the authority to provide alternate procedures for determining family size when the student's household size or financial information has changed significantly since the prior year, such as children being born or adopted after the end of the prior tax year. This also includes divorce settlements with multiple support agreements. A multiple support agreement specifies which parent can claim the children as dependents on their federal income tax return. Parents who are getting divorced or separated should consider the potential impact of multiple support agreements on eligibility for need-based financial aid when drafting the financial settlement and the child custody agreement. Now, I've seen a draft of the PDF version of the FAFSA, and it does have questions relating to family size. And I've also seen screen snapshots of the draft online FAFSA, and it has the ability for families to say that the family size downloaded from the IRS is no longer accurate, and here's the correct number. Now, if more than one parent could claim the child as a dependent on their federal income tax return, then the parent who is allowed to claim the child is based on the parent with whom the child lived the most during the tax year, or if the child resides with both parents equally, the parent with the highest adjusted gross income. So there's a complexity there. But as far as which parent is responsible for completing the FAFSA, it is based on whichever parent provides more financial support to the student. And if they provide equal financial support, it's whichever parent has the higher income. And that includes the income of any step parents if they've remarried. Now, there have been some changes to the cost of attendance. Some college financial aid administrators would set the room and board component of the cost of attendance to zero when a student lives at home with their parents, saying, well, they don't have any cost, which was not really realistic. That is no longer going to be permitted. It has to be a realistic measure now. And the U.S. Department of Education is going to be able to regulate the cost of attendance for the first time. The only thing they can't regulate is tuition and fees. So if there seems to be ongoing abuse of zeroing out the room and board component for parents, students who live with their parents, and they will deal with it. Now, colleges will now be allowed to include other transportation costs, not just the travel from home, school, and work. The addition of work is new, but they can include other transportation costs, such as conferences, field trips, medical residency interviews, if they are part of the student's program of study. The statutory language is an allowance for transportation, which may include transportation between campus residence and place of work, as determined by the institution. Now, there have been also some changes that switch some cost components from optional to mandatory and vice versa. These include room and board, rental or purchase of a personal computer, allowance for miscellaneous personal expenses, loan fees, and professional licensing costs. Colleges may include in the cost of attendance for less than half-time students any component that is not expressly prohibited by law. For example, co-op costs, but not miscellaneous personal expenses. The cost of obtaining a license, certification, or first professional credential must be included. It's no longer one time and may be the actual or average cost. Now, there have been some changes to financial aid appeals. College financial aid administrators can no longer have a policy of denying all professional judgment requests. Some colleges had a policy of denying all appeals to reduce their workload. For example, some community colleges would not consider appeals about a change in the student's income when the student quit their job to go back to school full time. This caused these students to not qualify for the federal Pell Grant. Remember, the FAFSA uses 2-year-old income information, so this would persist for 2 years, which is the typical length of an associate's degree and longer than for a certificate. And that caused serious problems for many students. All financial aid appeals must be considered on a case-by-case basis, and colleges cannot limit adjustments to just data elements of the FAFSA, but must allow adjustments to cost of attendance when appropriate. Um, and they can have a policy or practice that reviews everything on a case-by-case basis and then rejects everything. Now, a benefit for students who have unusual family situations where the family relationship has essentially dissolved is that dependency overrides are now going to be assumed to continue from one academic year to the next year for the duration of the student's college enrollment, unless there is conflicting evidence to the contrary. So previously, they had to apply for a dependency override each year. Now they no longer will need to do so if they're approved during the first year. College financial aid administrators can also rely on a dependency override at another college during the same or a prior award year. Colleges must evaluate their request for a dependency override within 60 days of the start of the student's enrollment. So it's got to be very prompt. Now, during a disaster, emergency, or economic downturn, financial administrators may set income earned from work to zero if the student can document receipt of or application for unemployment benefits within the last 90 days. Financial aid administrators can also use older documentation if there's no conflicting information. This encodes guidance that was issued in a Dear Colleague letter in 2005 and makes it law. The reason for this is Secretary DeVos during the Trump administration did not use this authority to provide college financial aid administrators with this flexibility during the COVID-19 national emergency. And several members of Congress were upset at that. And so it's now mandatory. It's no longer depends on the Secretary of Education. Now, if the parents refuse to complete the FAFSA, the most a student can get is an unsubsidized federal direct Stafford loan. It used to be the parents had to cut off all financial support to the student. Now it allows it even if the parents do not cut off that financial support. However, it's just the student loans. If the parents don't complete the FAFSA, the student will not be eligible for any other federal student aid. There's no real appeals process for this. The college financial aid administrators can't override this. So the goal is to get the parents to complete the FAFSA. And the financial aid administrators are pretty good at getting reluctant parents to complete the FAFSA by informing them it doesn't require you to borrow or to provide any financial support. It just enables your child to get federal, state, and institutional aid. Another change is emergency financial aid will no longer count as estimated financial assistance, which now has a new name of other financial assistance, when it covers a component of the cost of attendance. During the pandemic, there was guidance issued that under the HEROES Act that essentially implemented this, but now that the pandemic is over, the emergency financial aid now counts as estimated financial assistance, but the FAFSA Simplification Act changed that effective July 1, 2024, so that emergency financial aid will no longer reduce the student's need-based financial aid eligibility. Now, financial aid for other purposes other than the cost of attendance might still count, but it helps that cash support is no longer reported on the FAFSA. So in a way, there's no longer a place to report this emergency financial aid on the FAFSA. And that can include replacing or repairing a car, posting bail, and medical or dental expenses. Now we'll shift gears and talk a little bit about scholarships. This chart shows the average scholarship and fellowship award amounts from 1990 to the present. And you can see it's fairly steady growth. The average scholarship, and this is for all scholarships and fellowships. If we look just at students in bachelor degree programs, the average scholarship is $4,927, with 15.2% of these students, bachelor students in bachelor degree programs winning scholarships. That's about 1 in 6.6. Both of these are increases compared to the previous year for which we have data, which was 2015-16. It's based on a study that's conducted every 4 years, and the 2019-2020 studies data was just released last month. Now, of students in bachelor degree programs who win scholarships, a little bit more than half win less than $2,500. A third win $2,500 to $10,000. 15% win $10,000 or more. 3% win $25,000 or more, and 0.5% win $50,000 or more. So winning scholarships is part of the plan for paying for college, but it's not the entire plan for most students. Now, if we look at the impact of high school GPA on scholarships, you can see that from this chart that the higher your GPA, the more likely you are to win a scholarship. Now, even though very few scholarships ask about a student's high school GPA, students with better grades are more likely to win scholarships because the characteristic that of students who do better academically also tend to do better in other aspects that matter to scholarship providers. Now, the bunching up in the rightmost column may be an indication of the impact of grade inflation. An A is the new B, in a way. And every decade, we see high school GPAs going up by 0.1%. And this is not just due to weighted GPAs. It's also due to high schools being more likely to just give better grades to their students, which I think does a disservice to the students because it doesn't really give them the feedback they need in order to perform better. Now, the similar effect appears on SAT test scores, except we don't see as much of a bunching up effect because the SAT has not been subject to grade inflation like GPA has been. Now, again, very few scholarships ask about a student's admission test scores, but students with better SAT and ACT test scores are more likely to win scholarships because it's some characteristic of theirs that students who do better academically are also more likely to do better in other areas, like more engaged in hobbies and volunteering and musical instruments and the like. And this, even though I labeled this chart as SAT test scores, it also incorporates ACT test scores by converting them to the equivalent SAT test scores. Now, there's a strong correlation between high school GPA and college graduation. And this is a slide from one of my books, Who Graduates from College, Who Doesn't. It's based on the 2009 follow-up to the 2003-04 Beginning Post-Secondary Students Longitudinal Study. It shows the percentage of first-time full-time freshmen in 2003-04 who intended to obtain a bachelor's degree and succeeded in obtaining a bachelor's degree within 6 years, disaggregated by high school GPA. More than 2/3 of the students with a high school GPA of at least a 3.0 on a 4.0 scale attained a bachelor's degree within 6 years. So high school GPA is very strongly predictive of college graduation. The SAT, much less so, but there's still a correlation. Taking more math is also predictive of college graduation. People who take beyond Algebra 2 are more likely to graduate than people who don't take math beyond Algebra 2. It's significantly more likely. And it's a continuum. The more math you have, the more likely you are to graduate. Now let's talk about student loan debt. So there have been a bunch of student loan debt milestones that have been released in the last decade or so. Student loan debt is now a macroeconomic factor, but a weak one, with annual student loan payments accounting for only 0.4% of GDP, gross domestic product. In 2012, the $1 trillion in outstanding student loan debt included both federal and private student loan debt for undergraduate and graduate professional students, as well as parent education loans. The 2014 milestones are a sign of the economic recovery. The current outstanding student loan debt continues to exceed auto loan debt and credit card debt, but is much less than the almost $9 trillion in mortgage debt, even though mortgage debt is still down from its peak of a bit more than $9 trillion in 2008.
Mark, we have a lot of great questions coming in. So just let me know when you think we can move to those questions, because I know people want to hear your insight on all these great questions.
There's 3 more slides.
Okay.
So the total student loan debt outstanding has grown quite steadily. It's almost linear up until the pandemic. And you can see the slight curve where the growth rate is slowed down a little bit. You still have new students at college borrowing student loans, but during the pandemic, there was an interest waiver, and that interest was no longer accruing. And so the growth rate was a little bit slower as a result. And I'm expecting that it'll return to linear when interest, with the restart of repayment, interest started accruing again on September 1st, and the first payments will be due in October. And total student loan debt outstanding grows at a steady rate due to a constant influx of new borrowers. Also, student loans are repaid over decades, not months to years like credit cards, so the debt persists. It's 2 steps forward, 1 step back when new debt versus paying down old debt. And if the growth rate continues at the same rate, we will probably reach $2 trillion by the year 2026. This chart shows something I call the College Affordability Index, which is the ratio of the net price, the 1-year net price of the college, to total family income. And everybody struggles to pay for college, regardless of income. But this chart shows that low-income students spend a greater share of total income on higher education than middle and high and than middle-income students. And middle-income students pay a greater share than higher-income students. And the trend has been getting worse at all income levels. And note that middle-income families pay a smaller share to attend a private nonprofit four-year college than low-income students pay to attend a community college. Yeah. All right, so I think we can open it up to questions.
Okay. Well, thank you, Mark, for all that great information. It's a lot to take in. I also just want to note that there are a few people that asked questions early in the presentation that you did cover, but I'm still going to read the questions because they might have asked some for additional insight. So the first question is there a particular income threshold beyond which families should not expect to receive aid? In those cases, do you still suggest that families fill out the FAFSA?
Right, so there is no explicit income cutoff, but if you can afford to pay for college from pocket change, you're probably not get any need-based grants. So if you have a 6-figure income and your child's attending an in-state public college, you're probably not getting any grants. Remember, the financial aid is based on financial need, which is defined as the difference between the cost of attendance and the student aid index. And there are 2 ways you can have a greater amount of financial need. One is to have a lower student aid index, as low as 0, or some cases lower than 0. The other is to attend a higher cost college. So a student who doesn't qualify for any grants at an in-state public college might nevertheless qualify for some grants at a high-cost private nonprofit college, which tend to be among the most expensive. And there are still some reasons to file the FAFSA, even if you're extremely wealthy. Um, the FAFSA is a prerequisite for federal student loans, which have, especially for the student loans, relatively low interest rates. And if you think that the child needs to have skin in the game, it's a reasonable way for them to have skin in the game. You should aim to have no total student loan debt at graduation that is less than your annual expected starting salary. If your total debt is less than annual income, you should be able to repay the student loans in 10 years or less, which is a reasonable amount of time. But otherwise, you'll struggle to make the student loan payments, and you'll need extended repayment or income-driven repayment to get the payments down to a more affordable level. So with the federal direct Stafford loans, uh, it is very difficult for you to borrow more for your education than uh, your expected starting salary. It's still possible, but not very common. In order to get above that threshold, you need private student loans or parent loans on top of the federal student loans.
Can filling out the FAFSA reduce the chance of admission to certain colleges and universities?
Yes. Most colleges have need-sensitive admission or need-aware admission, where typically they admit the first 3/4 of students to their class without regard to financial need. But then when their financial aid budget gets exhausted, they start considering uh, whether the student's going to need financial aid. Now, that doesn't mean that you can skip filing the FAFSA for the first year or wait until after the student is admitted and then file the FAFSA, and then suddenly get the institutional grants. Most of the colleges that have need-aware admissions have a policy that unless there has been a drastic change in the family's financial circumstances, if you don't apply for financial aid for the freshman year, you're not going to get institutional grants in subsequent years. So don't think that you can just wing it for 1 year and then um, succeed in getting aid the subsequent years. You won't get that aid, and that usually results in two consequences. You have to take on too much debt, or you have to transfer to a less expensive college because you run out of your own funds to pay for the college. So I don't recommend doing this. Now, there's only about 100 colleges that have need-blind admission where they don't consider financial need at all, and that meet full demonstrated financial need according to their own definition. So most colleges are need sensitive in some way. Some of them, it's not need sensitive in the initial applicant pool, but maybe for the wait list. I mean, even some need blind colleges may start considering financial need for the wait list or for international students.
Okay, here's another one. Will people still need to disclose all 529s versus the one for the student on the FAFSA? And you did discuss this a little bit, but I'll let you answer that.
Right. So one change, and so currently in the current FAFSA and not the new FAFSA, you had to report all 529 plans that were owned by the student, a custodial 529 plan, or that were owned by the parent if the student was a dependent student. One change in the law is that if the parent owns 529 plans for siblings of the students, those 529 plans don't get reported as an asset. So it's just where the student's a beneficiary, where it's owned by the student, or if the student's a dependent student, that student's parent. If the student's an independent student, then it's all. I believe it's even if the student owns a 529 plan for one of their children. Now, 529 plans that are owned by anybody else, grandparents, aunts, uncles, complete strangers. If the parents are divorced, the parent who doesn't complete the FAFSA also falls into that group. They're not reported as assets on the FAFSA, and distributions from these 529 plans will no longer be reported as income, untaxed income on the FAFSA. Now, that's just qualified distributions to pay for higher education costs. If You take a non-qualified distribution, it's counted in adjusted gross income, and therefore will affect the student aid index. Now, there's a draft of the printed FAFSA form where they made some changes to the instructions that suggest that maybe even a broader impact. I think they made a typo in how they modified that, so I'm not going to confuse you by providing that information.
Okay, divorce. There's a lot of back and forth about whether the parent claiming the student on taxes needs to be the same parent who fills out the FAFSA.
Right. So it's the parent who provides more financial support to the student. And that that can be that can include, for example, if the student's living with a parent, that parent is providing housing and food in addition to any cash. You also have the child support that is paid by one parent to the other. And so the way to tell is to do the math. You have to calculate all the expenses, who's paying it, how much is being paid, whether it's cash or in kind, and then figure it out. Now, the interesting thing is that there is no real verification of this. So the parents can basically, between the two of them, decide which parent is going to be responsible for completing the FAFSA. And so long as there's nothing really odd about it that's going to get the financial aid administrator to question the veracity, they have to take it at face value. And so, and you can choose to have the parent who has the lower income be the one who completes the FAFSA. But if that parent has no income whatsoever and doesn't have any child support and doesn't have any alimony, the college financial aid administrator is going to question how they were able to support themselves.
Mhm.
So, but you do have some flexibility.
Mhm. Here's another one. I started an LLC in March of 2023. I have only incurred a loss. Do I need to say I have a business? Prior to March, I only have W-2s.
Right. So the business, all businesses that are owned by you have to be reported. Now, the fact that it had, and it's not just reporting as an asset, it's also reporting any income you receive from the business because that's part of your income. And that shows up on your federal income tax return. But keep in mind, it's a prior year for income. It is as of the date you file the FAFSA for assets. So you would report that business as an asset. But if that business has been losing money and maybe it has some tangible assets like some equipment, a computer, or something, but you use borrowed money to pay for it, then it may have no net asset value because it's the net worth of the business that matters, not the top line number.
Okay. Tied to that, I'm a displaced worker since May within the motion picture industry. Is there anywhere in the FAFSA to write this? Like, because again, prior year, but currently unemployed.
Right. So it used to be that displacement was involved in the simplified needs test and auto zero HC. That gets dropped with the 2024-25 FAFSA, but you can do a financial aid appeal based on your being displaced or dislocated worker, like being unemployed. After you file the FAFSA, you would contact the college financial aid office and with a short letter, 1 or 2 pages at most, where you identify the special circumstances that affect your ability to pay for college, and you summarize them. A sentence should be enough, along with the financial impact. You have to be specific as to dates and amounts. So it could be that a dislocated worker, so you lost your job, you no longer have health insurance, or you now have to pay for health insurance from the exchanges, and your healthcare costs have skyrocketed, or maybe you lost your job because you became disabled, and due to some medical issue. Technically, the employers are not supposed to do that, but that's the reality, and you can let the college know. I find that when it rains, it pours. It's usually that you have multiple special circumstances, not just one. But you include that in the letter. You include copies, not originals, of documentation of these special circumstances. Um, and it's best to have third-party documentation, not just your assertion. And you send it to the school. Some schools will have you send it electronically. In some cases, you'll send it by postal mail. Um, if you send it by postal mail, get delivery confirmation so you know that it was received. And then about a week after you send it, call the school, ask them, do you need any more information? That's a way of confirming that they received it, and they will know. And oh, and there's a particular set of documentation that they need, and they will let you know. And then most schools have a committee that reviews these, and they determine if it merits an adjustment. And if it merits an adjustment, it'll be either to the data elements on the FAFSA or the cost of attendance information. For example, if your income 2 years ago was much higher than it is now, you got laid off, and so you have no income coming in, they will usually make an adjustment to the income data element on the FAFSA. That will then go through the typical formula, and out will pop a new student aid index, which will lead to a new um, financial aid package. So other than the subjectivity of deciding whether or not it merits an adjustment, everything is formulaic. So it's not that they feel pity and they say, "Oh, let's give them another $1,000 of financial aid." It's all by the formulas.
Okay, here's a question. With the number of children not in the SAI calculation, how will colleges react to this for current students in college who are receiving aid but will no longer qualify? Will they do more appeals, start using the CSS profile, or something else?
Well, so you can always appeal based on the sharp change in financial aid due to the elimination of the number in college. Colleges can't modify the formula, so they can't put back in the division of the parent contribution. But they may they can choose to make adjustments, say, to income. Before, when the parents were in college at the same time as their child, some colleges would make adjustments, either by adding the parents into the number in college, or more often reducing the parent income by the actual amount paid for the parents' tuition. But there was a lot of abuse of this, and so the schools would require copies of a paid bursar's bill for the parents' education, or they would even call the other college to get confirmation, because sometimes people would just forge a bursar's bill. Um, and I would expect that they're not going to do it for everybody, because I mean, a significant number of families have multiple children in college at the same time. But maybe if you have quintuplets in college all at the same time, they might make an adjustment. Or and some colleges will make an adjustment using their own funds. Um, the CSS profile form, which is used by 186 colleges for awarding their own financial aid funds, appears to still be using their own adjustment based on the number in college, which was less generous than the old FAFSA adjustment. But it looks like they're still going to do that. Though the College Board hasn't released a copy of their formula since 2015.
A quick follow-up about CSS. Here's a question. A lot of the schools require both FAFSA and CSS. Will the CSS have more weight this year as it opens in October?
Right. So the FAFSA is used for awarding federal and state aid. At most colleges, it also has an impact on institutional aid from the college itself. Only at 186 colleges, which is a small fraction of the several thousand colleges, do they use the CSS profile for awarding their own financial aid funds. So it's not, the CSS profile does not affect federal and state aid. It affects only institutional aid. And so it's probably not going to have much of an impact, any more of an impact than it did before. But clearly, if you were getting substantial financial aid because you had triplets in college last year and then still have them this year, but all of a sudden your financial aid went down by $10,000, definitely appeal. Um, and it's not the sort of thing that they normally make an adjustment for because they don't make adjustments for changes in the financial aid formula. But uh, ask the college, and some colleges may make an adjustment because they don't want to see students dropping out of college because the affordability changed drastically. But if you're a parent of an incoming freshman and you don't have other students in college, uh, appealing is probably going to be ineffective.
Yeah.
So the colleges that are going to make adjustments are primarily going to make it for returning students.
Okay. Is prior year for students graduating high school in 2024, is that year 2022, even though they complete the FAFSA in 2023?
Okay, so prior year is based on the year for which aid is requested. So for 2024-25, it is based on 2022 income.
Okay.
Because in 2023, you file your federal income tax return for 2022, and that's the most recent verified income that's available, and that's the income that will be transferred from the IRS with the direct data exchange, which is the new which replaces the IRS data retrieval tool into the FAFSA.
Okay. How does unemployment in 2022, how's that evaluated? Is there also a way of communicating the unemployment was persistent until 2023, even though unemployment assistance ended?
All right. So if you are unemployed, so your prior year income is no longer reflective of your ability to pay, contact the school, ask for an appeal. Changes in income are the number one reason why people appeal for more financial aid, and it is the type of appeal that is most likely to result in adjustment. Now, the colleges have flexibility. They can use any 12-month period as a substitute for the prior year when the prior year is no longer reflective of the ability to pay. So they could use 2023 income. You can't, they can, or they could estimate what your income is going to be in the 2024-25 in the academic year or in calendar year 2024. They can do whatever they want, whatever they think is going to be most reflective of the family's ability to pay during that academic year.
Do you have any advice for parents of twins?
Well, one thing is visit the Twins Festival in Twinsburg because there are a lot of other parents, some who have children who've already graduated, and they may be able to give you advice. There are some scholarships for twins, and there's even one college that has a BOGO. Both your children attend the same college. One of them has free tuition, the other pays full tuition, and they alternate each year. So one twin gets it one year, the other twin gets it the next year. So search some of the free scholarship matching websites because they all have questions, whether you have twins or multiples. Sometimes when you have an unusual number of children born at the same time, there will be a news media blitz, and some local college will offer you to have free tuition and when they reach college age. So, and getting media publicity when you have newborn twins or multiples is can help a lot. But you can appeal to the college, and stressing that you have multiple children in college at the same time and you don't have any greater ability to pay. That this wasn't a timing choice that you engaged in. It was just something beyond your control.
Yep.
And oftentimes, when you're appealing for more financial aid, emphasizing that the circumstances were beyond your control can sometimes help you get approved for an adjustment.
Okay. What are you seeing in terms of accurate financial aid calculators being updated? Is my intuition updated with some of the key changes to SAI? How do you advise parents on running the numbers to determine financial fit?
Right. So I would expect that we're not going to see accurate financial aid calculators until
Mm.
sometime early next year, because the U.S. Department of Education has not released the full details of the formula. There is a draft document that gives some details, but it doesn't answer a whole bunch of questions. And I've used that, and well, some people have used that to implement calculators. Um, it's not guaranteed to be accurate.
Mm.
I've used that along with data I have for the last 20 years of EFC calculations to analyze what the impact of the various variables and changes are going to be, and to also graph where I expect the average EFC to be for various income bands. That was used by the New York Times in an article. One surprising thing, besides the obvious things like number of children in college having a big impact on middle and high income families that have multiple children in college at the same time, is the elimination of the state and other tax allowance from the FAFSA is going to have a big impact for people who live in high tax states. The reason why they got rid of it is it had little connection to reality. It was based on federal income tax return data for people who itemized deductions and claimed a state and local income tax deduction. That tends to be people who are wealthier, um, and people who live in higher tax states. It doesn't reflect middle and low income families. And there's a $10,000 cap on what are called SALT taxes, state and local taxes, that make it even less realistic. So they just got rid of it. Now, and they did increase the income protection allowance a bit, but it doesn't fully compensate. So if you're in a state that has a high state income tax rate, like, I don't know, New York, for example, um, you may see thousands of dollars of difference in your EFC because they dropped that adjustment to income. So that's one of the things that will be a little bit of a surprise for some families. Um, the other ones we've already discussed, and that's the number in college, small business exclusion, family farm exclusion. Those will have a big impact.
Okay, we have one more. When should families expect their financial award this year, since the FAFSA won't be available until December?
Right. So the FAFSA, first of all, as soon as it comes out, you fill out the FAFSA. Even in previous years, filing the FAFSA earlier tended to lead to more financial aid, because some financial aid is on a first come, first served basis, such as the campus-based financial aid like Federal Work Study and the Federal Supplemental Educational Opportunity Grant. Some colleges have early deadlines for their own institutional awards, so they have preferred deadlines and regular deadlines. So it was always better to file it sooner. People who filed the FAFSA in the first 3 months tended to get twice as much financial aid on average as people filed it after the first 3 months. Now, some states have changed their state aid deadlines. Um, for example, California used to be a March 2nd, and now it's either April 2nd. I think it's April 2nd. And there have been some that had March deadlines that are now May deadlines. So you have a little bit more flexibility. But the colleges are still going to try to get the aid packages out on the same time frame. They're going to be crunched. They're always crunched this time of year. And February is no vacation period for college financial aid administrators, and you're usually working 14, 15-hour days. But they're going to try to get it done. But of course, and it all depends if you do your part and you file the FAFSA as soon as possible. Now, some of the colleges use automated packaging, and they use systems like Banner and PowerFades to automate the processing of FAFSA data or other financial aid application forms. So the initial financial aid package is automatically created, but then they review it manually just to make sure that there aren't any anomalies or other things that need to be considered.
Well, Mark, thank you very much for your deep knowledge on this subject. Here at Polygence, we're very thankful that you were willing to come and speak to our partners. And for those attendees, thank you for coming. We appreciate you as well. If you have any questions, my partner CJ and I are always here. We'd love to have meetings with you, to talk to you. If you have CJ's or my emails, you can reach out to us directly. But I also put the partnerships at polygence.org into the chat if you want to copy that and reach out. CJ and I are always happy to talk to you. Okay. Everyone, thank you very much and have a great rest of your Monday. Thanks. Bye.
Bye.